Welcome to this presentation on the application of ergotics to economic analysis. I am new to ergotics, having found the work of Ole Peters on Twitter a few months ago, but I've been around economics for a while. I assume the viewer is familiar with the term, if not the concept. I liked his approach to the subject, and this is a response to some of his thinking, particularly with respect to a hypothesized direct relationship between ergodic determinism and bounded rationality, in contrast with the application of neoclassical assumptions of rational omniscience to both policy and financial market formation. I would call the concept of rational decision-making focused rather than bounded, though this original term does indicate rational constraints, since it is varied focus on the transactional utility of each party that gauges or weights the exchange. Purchase of a good or service normally narrows the focus of the trade for an intended utility, while selling in exchange for monetary value normally broadens the focus of the recipient to a liquid, generalized utility which may or may not have a perceived in-use or urgency at the time of the sale. This urgency may be greater for buyer or seller or more or less equal. But what is essential in understanding the exchange between microstates is that the reason focus of the parties is never the same. It is what initiates a transaction in the first place. Ergodidiocy and the nature of modeling human experience, a video start for economics and ergodicity, is the selected title, which I think may have an applicability beyond the realm of economics. My name, as shown, is Martin Gibson. The initial tongue-in-cheek portmanteau of the title actually led to a deeper understanding of the subject as it became clear that the term idiocy, referring to a demonstrated lack of expertise by someone operating in the public realm for which sufficient expertise is assumed, is often elicited from a name-caller when faced with the uncertainty of a public situation, in hopes of a clarifying response. Unless they are maleficent, people don't normally call another person an idiot if they think that person is truly mentally deficient, or when they think that person is doing the best they can. The term is normally reserved for individuals or groups that do not appear to be showing the anticipated awareness and respect for their position in what is perceived to be a shared public space. In the marketplace of ideas and products, this notion of buyer beware acknowledges this fact. Ergodidiocy, then, references both the ergodic rational statistical assumptions one might expect to encounter in the public realm and an uncertain but unsurprising degree of inexperience and fecklessness in the marketplace of ideas and products, while still based on some valid reason of one sort or another as a form of focused rationality. My work in the design, construction, real estate, and related fields DBA Unified Services Enterprise, or Uniservant, segued into risk management in the form of catastrophe insurance claims adjusting in the early 1990s. That led to a renewed interest in macroeconomic theory and policy thinking in the run-up to the housing finance crash of 2008. This led to my reawakened economics work linked here. This includes a downloadable basic income app that can be used for comparing taxation, borrowing, and federal fiat funding alternatives for various public policy needs and initiatives. An interesting result of my research is found in the linked website and downloadable working paper entitled The Browser Economy, is the hitherto unrecognized, to my knowledge, presence of an optimization factor operative in the ratio of capital to consumption goods production, which is equal to that of consumption to total production, as found in the macroeconomic data of the past half century. This ratio is that of the golden mean, 0.618033, familiar to mathematicians and geometers as a natural growth constraint. An EE workbook template can be downloaded from the uniservant.org site and is the basis for the following 3 workbook compilation sheets, which is an overview of the presentation and can serve as a synopsis for a few-minute duration. A view of the whole presentation, which is a little over an hour and which goes into some detail on the logic and architecture of the workbooks, is encouraged for those who have the time. Ergotics postulates that the evolution of individual elements or microstates of a system as the average of each state over time equals the average of all those microstates at a given point in time. This structure as a probability distribution can be shown, grouped per 6 combinatorial tiers generated by a sequence of 5 flips of an unbiased coin according to a count and values of the possible head 1 and tail 0 permutations, as shown here in 3 ways. As the weighted probability per microstate given as a percentage of the macrostate M distribution. That same unweighted probability expressed per microstate as a unit valued average 1.0 of the macrostate M total, and as a weighted probability expressed per microstate as a compounded factored value, here with a factor of 50% added to the head or caput and deducted from the tail or cauda for the evolution of each microstate. The overall microstate structure, showing the full range and hierarchical sorting of the permutations of the 6 tiers, is not seen in these first 3 compilation sheets. It requires a look at the individual spreadsheets later in the full presentation to grasp its significance. This ergodic structure can then be applied to the economic data of the distributional national accounts at federalreserve.gov. The idea is that the probabilities of the first row, microstates, at 3.1% represents a flow in the form of energy, nutrition, and other basic life requirements required to sustain the stock of the second row microstates as a human being or human group as human capital of non-market based value average of 1.0. The third row is weighted probability, represents a market-derived microstate value as a percentage of the macrostate total, as defined by the focused rationality decision-making of each microstate with respect to either flow, as for example GDP, or stock, as human, real, and financial capital. The next sheet gives a compilation of comparison of several different weightings over 5 iterated states to give a populated distribution of 32 microstates. The top table gives the ergodic evolution of weighted value expressed relative to the unit of human capital as 1.0, as flows or stocks, to 32 microstates per microstate arranged in valued tiers with a macrostate total of 32. The middle table gives the same data, but the microstate values summed in each tier as shown. The bottom table gives the same sum data valued for each tier as a percentage of each weighted macrostate. The yellow cells indicate a sustainability deficit or threshold. The blue row selection indicates a general confirmation to the fourth quarter 1989 Fed income data. The pink row indicates a general confirmation to the fourth quarter 1989 Fed net worth data and to the fourth quarter 2019 Fed income data. The orange indicates a general confirmation to the fourth quarter 2019 Fed net worth data. The third sheet gives a detailed comparison with adjustments to the Fed categories for confirmation to the weighted ergodic distributions and future projections. The Fed figures are grouped differently from each other for income and for net worth, and again with respect to the tier percentages of the weighted ergodic framework, and have therefore required adjustment as indicated for comparison with that framework. This confirmation shows a high degree of correlation between the adjusted Fed categories and the weighted ergodic evolutions chosen, appearing to confirm the ergodic deterministic nature of long-term market dynamics. This suggests further study. In terms of a spreadsheet, as presented here, an ensemble is represented for the evolution of the system by each row of the table at given points in time. Seen here for each of the iterations states, base 1, 2, 3, 4, and 5. The columns represent a generation of binary flips of a coin over time, starting at the top row, iteration state base, to create the form of an inverted tree. We started by setting up a couple of workbooks to emulate the tossing of an unbiased coin to establish a recognized pattern of probability distribution. We've stopped with 5 iterations of the flip, which will suffice for demonstration purposes. Rather than using a Monte Carlo method for compiling a large number of random samplings to look for the emergence of deterministic patterns, we'll assume a deterministic pattern that is obviously ergodic and compare it with economic data which is assumed to be not so patterned. It bears noting that random modeling does not preclude the emergence of pattern formation in chaos theory. In a departure perhaps from similar considerations, we are not interested in compiling the random tracks of a series of 5 separate flips, where each flip results in either a head, which we will refer to as a caput, or a tail, referred to as a cauda. For example, the first 3 might result in the binary designations alt11, alt1, 1 alt alt 1 1, and alt 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 1 alt. We know that with 5 flips, each has a chance of having one of 32 binary designations, as shown at the bottom in row 5. However, in a series of 32 iterations, each consisting of 5 flips, there is a probability that several of the designations will be landed on more than once, and some not at all. That is not what we're after here. That would simply give us a history of the flips, but tell us nothing about the probability of the next series. Instead of flipping a coin, we have created a bracket similar to half of one that might be used in the March Madness basketball tournament. for tabulating the probability distribution of a fair coin, and we get the pattern shown on our overview sheet. We will take a look at this in some detail. All the data other than the option to enter a title, date, and comments at the top of each sheet is entered on the control sheet accessed on the bottom tabs. The global factor shown at the top left has two options for the primary population of the distribution. The conserved field is manually entered as a value between 0 and 1, or 0 and -1. This factor is automatically added to the base as the base plus factor on the caput side and subtracted from the base as the base minus factor on the cauda side. Entry of a positive factor between 0 and 1 skews the distribution to the caput side, while entering a negative sense to the conserved factor will skew it to the right. We can look at this in the overview. First, in the positive caput skewing shown here. And then in the negative, where the cauda side is skewed. The distribution is extended and enhanced by the same factors automatically throughout the 5 iterations of the macrostate. As a result, each iteration doubles the number and the value at each doubling. Taking the factored amount from the cauda and adding it to the caput microstate. In this sense, the doubling as averaged across each macrostate is conserved. As an alternative to the conserved selection, and as specifically intended for the initial baseflow worksheet, selection of the bilateral field with an X and entry of the caput and cauda fields with any amounts as desired by the user adds and subtracts the amounts as before for processing. Using the amounts of minus 0.50 for caput and 0.50 for cauda populates the iteration fields with the correct probabilities for the microstates of the distribution. The figures here are rounded to 2 places, but sum correctly across each ensemble. As a result, we can see that the distribution is ergodic. The values as anticipated at each microstate for the base plus 5 iteration states is 1.0, 0.50, 0.25, 0.125, 0.0625, and 0.03125, and is equal to the average across each of the states. On the overview sheet, the 5 boxes below the distribution, though not of much interest now, offer averages of various totals and subtotals above and below 1 for each of the 5 iterations. Going back to the control sheet, The cell modifiers, not used at this stage of analysis, offer two additional parameters if selected and entered by the user. The first, state, offers the option of entering a base figure other than 1 and the option of entering an inflation or other modifier for each of the 5 states. The parsing modifier, if selected, allows single microstate entry of chosen elements down to the level of the 4th state. It is conservative in that whatever figure is entered will be added to the caput side and subtracted from the cauda, unless a negative is entered on the modifier, in which case it will reverse the skewing. Descriptions of the base and state entries are user-defined, along with comment, category, and detail if desired for analysis. The charts sheet shows a graphic for each of the iterations based on the population of the microstates for each. Here it's a flat distribution, so of course we have the same values for each of the iterations, for each of the microstates through each of the iterations. We then have 5 iter sheets for a single iteration statement of the data along with the corresponding graph. 5th iteration, 4th, 3rd, 2nd, and 1. The base stock workbook is preset with a factor of 0, which sets all the values of the microstates to 1, demonstrating by the values of the averages of each state and for each element flip that it is ergodic as well. We observe that the graphs for the base flow and base stock are both flat and they reflect one another. In anticipation of the application of ergotics to economics, we have labeled the spreadsheets to reflect the fact that the base flow on the 5th state, a microstate value of 3.1%, reflects its portion as 1/32 of the total resource base. That resource might be what is produced or harvested and serves to sustain the life of each microstate on an ongoing basis as income, be they individuals or family groups in a simple browser economy or larger aggregate groupings in a more advanced egalitarian society. The stock represents the same portion, but is 1 unit of human capital, be it individual or group, along with related real capital and entitlements for the total of 32 as microstates of net worth. Both the flow and the stock represent physical processes or states quantified as percentages of the total and not financial or monetary asset valuations of income and net worth. We look next at worksheet W50% as the first example of a weighted probability as a weighted ergodic distribution. Here the factor of 50% is chosen to reflect the fact that the extreme right cauda, designated as quintuple alt for the 5th iteration, has the same value as 0.031 as a flow in the unbiased probability distribution. The average for the whole ensemble remains 1.0, based on the total of 32 microstates, with 32 as a sum total across the macrostate. We think of 0.031 as a subsistence income against the human capital value of 1.0 for microstate quintuple naught. In the scenario, 0.031 is the income flow needed to sustain the human capital value of 1 on an ongoing basis. As a result, W50 indicates one of the several inflection points in the various possible weightings, since the factor greater than 0.5 will cause quintuple naught to be operating at a subsistence deficit. If we look at various other weightings less than 0.5, all of the microstates, including this low one, are sustainable. This is not the same as saying they are self-sustaining, since the economy is based on an interrelationship of resource supply and product demand, where any microstate should be seen as a result of trade or exchange between microstates. Sustainability means that microstate is sustainable within the conditions established by such a market economy. In fact, it is the nature of this exchange that is responsible for the skewing of the distribution in a condition that is known as bounded rationality in economic decision-making. Note that while the average net worth across the ensemble remains an invariant 1.0, at this level of factor, fully 26 microstates are valued at less than 1. 10 of these are valued at 0.84, perhaps respectably middle class, but still in debt, we might surmise. 10 more are lower middle class or working class at 0.28, while 5 are working poor at 0.09, leaving 1 to subsist at 0.3. Of those with an average over 1, 5 are upper middle class and well off at 2.53, and 1 microstate, the top caput at 11111, is truly wealthy in the catbird seat at 7.59. We will find this particular 50% weighted ergodic structure is reflected in the U.S. Fed data for the fourth quarter of 1989 household income accounts. Another inflection point can be seen in workbook W38, 19%. As shown here. As a point prior to which half of the ensemble averaged above 1, making it solidly middle class, though the average of the top tier of 10 below 1 is only 0.45, while the bottom half averages 0.35. Workbook 10, we might call it a tithe, is basically egalitarian, as seen here. We'll look at some charts of these. Here's at 10. Gives us a better feel for the distribution here at the 5th iteration. Not terribly askew. Back at 38, we start to see the emergence of some of hierarchy, more pronounced hierarchy. %, is even more pronounced. Once the 50% threshold is surpassed, the sustainability issue in terms of quality of life and a social safety net issues of basic necessities, health, education, and retirement facilities become increasingly corrosive as the tiers, one after another, fall below the thresholds of sustainability. We'll look now at some distributions for this is at 60%, which conforms to very closely to the fourth quarter 1989 net worth, household net worth distribution, also the fourth quarter 2019 income distribution. We can see here that some of the upper tiers are starting to vanish. When I say upper, I mean upper shown on this graph, which are actually in the cauda, generally 5 and 4 alt configurations. We go next to 72%, which represents the and conforms very closely with the net worth for the fourth quarter of 2019. We can see that even more of the microstates have vanished or are close to it. We then look at, I'm going to go to this configuration, which I've re-entered the conserved figure, the factor, weighting factor, at 86.4%, which would correspond with the net worth at some point in the future if we continue on this current path. You can see that most of the microstates have vanished for net worth, as far as net worth other than basically your clothes on your back, maybe some transportation, and a few things like that. And then we go to 92.8%, at which, let's see what that last one was again. Yeah. Looks very similar, but the here the 5 second tier microstates are at an inflection point where they are falling below the microstate of 1 for as we're figuring here as human capital. So that shows us we can go on up here to 100%, where that basically means that all the wealth is owned in the top 3%, and we see that all the other microstates have vanished. The only thing left is that top 3%. So looking at this another way, where we've got compiled figures for various weightings compared with each other. Once the 50% threshold is surpassed, the sustainability issue in terms of quality of life and social safety net issues of basic necessities, such as health, education, and retirement facilities, becomes increasingly corrosive as the tiers, one after another, fall below the thresholds of sustainability, indicated by the shaded yellow cells in our totals for the tiers. For the 3.1% at W60, 18.7% at W72, and 50% of the total below the sustainability of the W86.4. as these microstates are priced out of the marketplace. Workbook W92.8 represents a final point of inflection in which all the top microstates, all but the top microstate of 11111, at 3.1% of the total population, holds 83.2% of the net worth, and all the rest are at or below 1. Where 15.6% are barely sustained themselves at 1 by catering to the top tier, and 81.3% of the total are in the unsustainable range. At W100, all of the 96.875% rest are unsustainable. What is meant by unsustainable here? A dictatorship, benevolent or not, would need to provide everything the rest requires, provided they have the resources and productive apparatus to do so, outside of any market mechanism. What unsustainable means is that those microstates affected are outside of the boundaries of any exchange or trading mechanism that would sustain their involvement in the economic, and we might add, political process. Note that all these weighted scenarios have the bones of an ergodic structure, since any individual microstate has the capacity to find a path to 1.0. In fact, it continues to do so outside the marketplace of evaluation as non-market human capital. As the DNA encoded, developed, and sold, nourished, educated, and socialized bodies of spiritual beings of incredible complexity and intricacy, none of which can be created, motivated, empowered, and maintained in isolation in any marketplace. This means that this portion of stock, of capital, human along with public real capital, can only be evaluated on ensemble as an average and not by individual private household market and entitlement mechanisms. Public financial capital, debt or asset, is essentially meaningless, as the public is the insurer of last resort, and any defaults in a private accounting must be written off. Private finance is therefore a net sum zero condition, as one microstate's financial asset is another microstate's debt, which may or may not be collectible. As a result, the stock values in these scenarios represent an ensemble market valued net worth equal to the sum of the non-market capital of 1.0 per microstate, while the individual microstates consist of the skewed market values as factored by various percentages of 0 to 100. 0 represents the egalitarian ideal of utopian vision, perhaps of a Marxist on the left or a Christian collectivist on the right. 100% represents a hierarchical vision of any individual who believes the world would be better off if all their wants and needs answered to their whim and they were in the caput microstate. Or in the inverted case where the factor is minus 100% with a cauda of a Stalinist totalitarian state. Coining a new term, only some of these scenarios exhibit ergodidiocy, as with W0% or W100% left or right. Wisdom would be evidenced by a factor somewhere below the factor of 38% as an inflection point at which 31.3% of the ensemble fall out of the middle class, but in no case above the 50% scenario in which the microstates of the system begin to fall out of sustainability, as seen by the yellow shaded cells of the compiled worksheet data. The question becomes what generates the rise in the factors which result in such skewing, of which a few significant ones can be stated. We must reiterate that the branching of each microstate is conservative as presented here, and that the amount deducted from each cauda is added to the coupled caput. Each transaction exhibits weighted ergodicity. An understanding of the skewing, for which the stated factors are but an epiphenomenal effect of deeper motivations, suggests several causes. Primary is the nature of transaction itself. Does the transaction represent the purchase of a consumable or of an investment good or service as capital? Here, it should be understood that the purchase of any consumable is intended for the maintenance or enhancement of human capital, if only to please that human entity. Transactions occur because of a lack of self-sufficiency in a microstate, which induces such entity to go beyond or to shore up the boundaries of their microstate to acquire or maintain satisfaction. As a result, trade as commerce or productive employment of resources, human or natural, occurs at or across these boundaries. If the trade is equally satisfactory to both parties to the transaction, we can call the trade free or equitable. However, in varying degrees, having one party that is more knowledgeable, skilled, or entitled, or is better positioned in acquiring, producing, or negotiating, or is more ready, eager, able, and willing to make the exchange than the other, will skew the distribution. Thus, the party with a more powerful head, and let's face it, more powerful arm or army, with greater understanding, that caput will enhance their side of the transaction at the expense of the cauda. This feature of the macrostate, a condition of bounded rationality, differs according to the tier in which each microstate finds itself and constrains the downstream branching of the distribution. This also explains the fractal nature of that distribution. Even in the less fertile regions of the cauda, the bottom half of the distribution, a caput-like microstate with only one zero, expressly 0, 1, 1, 1, 1, equal in value to that of the other four other similar elements of that tier, can raise its beautiful, unruly, and ugly head. If we were to extend the iterations to suitable fine-grained analysis, we would see that some of the microstates of relatively equal value have arrived at their position from general proximity to the rank and file of the cauda. This occurs by making a few dollars on a repeated basis from a billion or so people, while others, rubbing elbows with the muckety-mucks in the caput, make their billions earning millions from a few thousand others. Before we address whether this skewing of the middle class is a result of nefarious intent, some of it is and some of it isn't, which we should try to address through public policy. We should first see if we can fit any of these weighted distributions to the U.S. Fed data. We have selected one of the most recent quarters from before the advent of COVID-19, fourth quarter 2019 household distributional accounts for income and net worth, and one from among the earliest in the database, fourth quarter 1989, both sorted by tiers and stated as percentages of the total. The tiers are grouped differently from each other and from the ergodic distribution. With income, sorting is by the top 1%, 80 to 99%, 60 to 80%, 40 to 60%, 20 to 40%, and 0 to 20%. For net worth, top 1%, 90 to 99%, 50 to 90%, and the bottom 50%. For weighted ergodicity, the caput is 3.1%, 15.6%, 31.3%, 31.3%, 15.6%, and 3.1% for the bottom cauda. The confirmation of the weighted scenarios does not have the same factor weighting for the income and net worth distributions for the same year, though the spread appears to be similar for each year. A 20% increase of net worth over the income distributions for both years, which are 30 years apart. These confirmations require an adjustment of the income and net worth categorical percentages for comparison with the weighted values, as noted in the attached worksheet summaries. The weighted scenarios compared against adjusted confirmations are as follows. W50% conforms with the fourth quarter 1989 income. W60% of the ergodic structure conforms with the fourth quarter 1989 net worth. That same W60 also conforms with very closely with the fourth quarter 2019 income, and the W72% with the fourth quarter 2019 net worth. The confirmations are sufficiently congruent with the general scenarios to suggest further and more detailed analysis. Some things that stand out in the analysis. As discussed, the adjusted 1989 income figure for the lowest tier, M505, represents approximately 8 million people at the threshold of unsustainability. The adjusted 1989 net worth figures for the lowest two tiers, M504 and M505, representing 48 million individuals, face a similar threshold. The adjusted figures for 2019 are similarly constrained at the threshold, but the bottom half of each population, with respect to both income and net worth, the percentages of M503, 04, and 05 for 2019 are approximately half of what they were in 1989. With respect to the declines of the 31.3% of the M502 from 89 to 2019, income is around 20% and the net worth is about 40%. That is the decline, is that percentage. In contrast, there has been little statistical significant change in the 15.6% of the next to the top tier, M501, for either income or net worth. Income actually increased slightly through net worth, though net worth decreased by roughly an equal amount. The significant fact is that all of the decreases of the lower 81.3% have accrued to the top 3.1% of the top tier, raising the income and net worth by over 33% of their initial percentages. If this trend were to continue in a corresponding fashion to the workbook's W72% and W86.3% at some time in the not too distant future, the income for the top tier would be 47% of the total, and the net worth would be 70.3%. The income for M501, the next tier down, would remain essentially unchanged. However, though the net worth would decrease by a third. In other words, the income is remaining more or less steady for that upper middle class, or that top next to the top 15%, but they are losing their net worth. The bottom 50% of the income would be reduced to 2% of the whole, and the net worth would have essentially vanished. That's the bottom 50%, no net worth. At W92.8%, net worth for the bottom 81.3% will all but vanish as well, and the next 15.6% will be reduced to the same percentage as an average microstate value of 1. So what does this mean for the U.S. and any similar economy? The skewing of income and net worth over time is a direct result of unregulated market forces that concentrate capital in a highly weighted ergodic manner. Because there is generally and axiomatically a caput side of any transaction, and that side has an advantage in the marketplace over that of the caller. The forces that can counteract that increase are programs that foster the general education and healthy well-being of the populace, transparency and administration of the necessary regulations, and implementation of sustained liquidity through issuance of a fiat modern monetary theory-like currency in the form of a universal basic income and targeted public infrastructure and safety net funding that preserves the private net and which includes elimination of the current divisive and unnecessary political wedge currently in place as the personal income tax. So let's put this in some microeconomic perspective. Businesses stay in business by selling products as goods and services. This means they must have customers with the wherewithal to buy those products. Those products are either used as intermediate goods and services in the production of other goods and services, they are consumed as final goods and services, or they are stored for later use as either intermediate or final goods and services. That wherewithal flows to customers by birth, gift, bequeathal, entitlement, or from selling goods and services that they have produced for others directly or through their employment by others. When that flow diminishes or dries up due to decreasing birth rates, gifts, bequeathals, entitlements, or through lack of access to employment facilities to produce goods and services for sale, the wherewithal from customers for buying the goods and services to keep the businesses viable diminishes or dries up with it. To stay in business, those businesses must curtail their outflow to other businesses for the required resources, including the labor of others. That curtailment leads to exploration of ways to reduce the outflow for both the material and human resources needed to stay in business. Such cost cutting is made urgent by competition for customers and resources and the suitability of substitution and the sourcing of those material and human resources at lower costs. This leads to outsourcing of resource supply domestically and, in a climate of falling transport and communication costs, offshore supply. When those resources, both material and human, are rationalized and fungible, those resources are said to be commoditized, which means that the cost of producing or maintaining those resources, including human, are reduced to the lowest economical feasible level. That doesn't mean the labor costs can't go lower based on technological considerations. It is such technological innovation that serves to reduce overall resource costs and has impetus to drive them lower. For overabundant human resources of any skill level, commoditization results in labor pricing that is only sufficient to compensate that labor from week to week, sometimes day to day, or even hour to hour. But not enough absent entitlement for long-term savings and investment, which means for education, health, vacation, retirement, and even shelter funding. That means the market system can't provide the funds necessary for commodity labor. Period. Nothing nefarious, facts of life. For those with the wherewithal to invest in new or existing businesses in such environment, there is a disincentive to target those funds towards commodity production or the employment of material or human resource not technologically driven. However, when so technologically driven, such businesses become attractive targets, as evident in the burgeoning growth of digital and online businesses, all of which has been built on the back of the public expenditures of the Defense Department in the construction and development of the Internet. The excess flows from these disintermediation industries have little incentive to invest in low-margin commodity production without any technological edge, or without customers with the wherewithal to purchase their goods and services, and so intensify their search for greater disintermediation. Disintermediation itself is driven by the general marketable persistence of a perceived prior existential need for survival and/or pleasure, for production of goods and services, for food and drink, amusement and adornment, sex, sport, mobility, shelter, and moderate living conditions when possible. Modern electrification, communication, and transportation is largely a response to that drive. Excess flows not deemed suitable for investment in direct commodity production or disintermediation, therefore has only two main directions for pooling the flow: either as upscale replacement assets as products of these existential needs, including real estate and advanced academic degrees, or as fungible financial products, money and its various stock derivatives. Absent any philanthropic impulse to cycle the flow to human and real capital and the lower cauda, this process will continue until the rationale and opportunity for disintermediation diminishes or dries up the flows of the lower 50%, then 80%, and finally all but the top 3.1% of the caput. Then Mr. Musk and friends can fly back and forth to Mars and vacation as they please. There is no feasible or reasonable way to address the existential needs of any of the microstates in the yellow zones if we want to rely solely on market mechanisms. Rational markets, by their nature, lead to a skewing of the distribution. Privatization has been conflated with expertise in much of the business and political mind, and has resulted in the obverse idiocy of thinking that public enterprise necessitates amateurism, or conversely, that only an expert would value private initiative, while only an amateur, an idiot, would seek public employment. Some essential work cannot and will never generate a profit, which means it cannot attract private capital for investment other than as a philanthropic enterprise. That doesn't mean it shouldn't be done well, and properly compensated. The key is to understand that the necessary funding of the public good does not need to compete with the needs of private funding by coming out of a tax or lending base, particularly when the public funding is for needed and often well-paying and well-thought-out medical, educational, and law enhancement investment out of fiat policy, which finds its way back into the private sector. The mistaken notion of supply-side economic thinking has led to disinvestment in the public sectors on a federal, state, and local level that began with the Reagan administration and which can be identified and tracked in the U.S. Federal Reserve Public Record. I invite you to look at my work in that regards on my website at uniservant.org, Political Economy. It has happened because the build it and they will come mentality that may occur on the level of financial portfolio managers with other people's money does not follow with the same intensity on the level of private individuals with personal business experience using their own money. These privately investing individuals are less likely to invest in businesses for which there is no proven or discernible customer base. Much less likely than are the abaci-toting whiz kids with transcendent notions of capital supremacy, that is, the caput. Caput. This capital illusion is coming to an end. The only true capital is in the heads and hearts, the souls of all human beings. Praise the Lord. This doesn't mean that all human capital is equal. The ideas coming from the heads of some human beings are sheer idiocy and deserve to suffer the same fate as the pet rock. Remember that? Good idea, and it worked for a while, I guess. The ideas and entrepreneurial efforts coming from private individuals in the marketplace, public and private, however, deserve consideration without considered public subsidy for reward and punishment by the envisioned customer base. But this market-based human capital value, as allocated by supply and demand, is but a portion of the total human capital, of which the non-market portion, as indicated in this analysis, that is God-designed, evolved, and endowed, is the major portion. In the 70 to 75% of the total range, as indicated by the U.S. Department of Commerce study of 2010, authored by a gentleman by the name of Christian. This human capital, this non-market human capital, is universally and should be universally allocated per capita as an ensemble average in this and related analysis. Any questions, boys and girls?